There are decades when nothing happens, and there are weeks or months when decades happen. Risk never comes knocking the door, and in financial markets, things often go wrong more than they go right. And today, considering the volatile times and the thaw of volatility, I think it's time to do housekeeping and analyze and strategize in order to mitigate currency as well as interest rate risk. Well, I'm Kunal Sodhani, your host from Global Trading Center, Shinhan Bank India. And yes, we are here to understand, decode, demystify domestic as well as global trends and analyze several currency pairs for you. So starting on the domestic front, let's talk about the FPI flows. If we talk about 2023, the FPI flows were to the tune of 2.37 lakh crores, while if we talk about 2024, the inflows were to the tune of 1.65 lakh crores. But if we talk about 2025 till March 25th, 2025 precisely, the flows has been negative to the tune of 80,000 crores. Now what happened in 2024? It was mainly because of one, the stimulus which was announced by China to boost their economy, and a lot of money flow went to China at that point in time. Also, the second reason was elevated valuations, which also pushed the flows moving to China. If we also talk about the FDI flows, that was quite crucial to understand because the net FDI flows is $1.18 billion for April to December 2024 from roughly around $7.84 billion in the same period a year ago. Well, the FDI flows definitely remains a concern, but why these flows have been a bit on the negative front? Mainly one, because of the repatriation, and secondly because of the overseas investments by Indian firms. If we talk about the repatriations data, the repatriations rose by almost around $44 billion for the first 9 months, and if we compare with the 9 months with the previous year, it was to the tune of $33 billion. If we talk about the overseas investment, they rose to almost around $17 billion from $11 billion from April to December 2024 itself, the same data compared with 2023. Now what's happening on the growth front, because there has been a discussion more of inflation as well as growth dynamics, but if we talk about the GDP number, the GDP number came in at around 6.2% for Q3 FY25 versus the last number was at 5.6% in Q2 FY25. Now yes, we have seen the growth rising, but is it in sync with the expectations? Possibly no at this point in time as per the projections. But what our personal projections remain for the year 2025, we expect the average GDP to be around 6.3%, and for FY26, our anticipation remains at 6.5%. Now, what's the reason behind it? We believe that there has been rural demand revival, the food inflation has been ticking lower, and also there has been lower tax burdens, capital expenditure flows will be coming into picture, which all will contribute towards the growth. In fact, we also had the Mahakumbh. These are the festivals which creates more consumption growth story. Thus, we anticipate the growth to be higher, and yes, India still remains the fastest growing economy in the world. But what happens with inflation? If we talk about inflation, the data came in at 3.61% in the month of February 2025 as against 4.31% in January. The major reason of the drop in inflation obviously goes to the food inflation. If we talk about the food inflation, it came in at 3.75% versus 6.02% in January. Yes, if we break this food inflation also into vegetable inflation and pulses, the vegetable inflation dropped to negative territory, negative 1.07% from almost around 11.35%, while if we talk about the pulses inflation, they also went into negative territory of 0.35% from 2.59% roughly in January. So these two have been a major contributors, but what do we see inflation dynamics working from here on? We continue to expect food inflation to be moderate, and we expect that the inflation trajectory on an average may remain near 4% only. So if we talk about the RBI band of 2 to 6%, or if we talk about the average 4% plus minus 2%, we still remain in a comfortable position. So I believe growth as well as inflation dynamics have been supportive. And if we draw this line towards what we expect in terms of the rates trajectory on the monetary policy front, we anticipate one rate cut in the month of April by 25 basis points by RBI. If we talk about the future path of RBI policies, that may depend on a couple of factors. One, obviously, it may depend on the GDP data which will be published at the end of May 2025, because that data will be crucial to determine the future trajectory of second half of the year in terms of rates. Also, there will be a dividend announcement by RBI, which again usually happens in May, where the anticipation remains of roughly around 2.5 lakh crores to 3 lakh crores of dividend which may be given to the government. So these two data will be very important. RBI has been doing a wonderful job in managing the liquidity. They have been seeing that the tightness in liquidity has to be curtailed, and this they have been doing OMOs, they have been doing buy-sell swaps into the FX market and also VRR. So they are managing that liquidity well. But if we also talk about the trade deficit numbers, we have seen the trade deficit numbers which have narrowed down to $14.05 billion for the month of February. While we believe the trade deficit numbers may widen here in the near months to come because of the consumption demand and the private consumption rising from here, but this is a healthy sign because these numbers were last seen in August 2021. If we break down and understand the exports and imports on an annual basis from April 2024 to Feb 2025, the exports merely rose by 0.1%, while the imports had risen by almost 5.7% in the same period. So yes, exports have not grown, which remains a concern for us at this point. But if we draw this line and understand how current account will be there basis on this number, then we anticipate current account to be in surplus to the tune of $5 billion for Q4 FY25, or roughly around 0.5% of GDP. Now, as we discussed on the rate cycle, let's also understand on the FX reserves and the FX intervention strategy which RBI has been holding now. In terms of the FX reserves, the all-time highs which we have seen in September 2024 stands at $704 billion, and if we also talk about the current number, we are standing roughly around $654 billion with respect to our FX reserves. Now, in terms of import cover, still it's a very decent number with 10 to 11 months of import cover at the current juncture. The buy-sell swaps are also adding to the FX reserves. From the lows of around $623 billion, we have bounced back to around $655 billion. The change in the intervention strategy definitely seems to be very effective because initially during the last governor's term, we have seen the daily range used to be around 10 paisa. It used to be managed quite sharply. But now if we talk about the current juncture and the current range, we are definitely seeing volatility back into the dollar-rupee pair on an average of 25 to 30 paisa a day, where intervention, if seen very heavily, or if not, they have been playing it around really well. So it's, I think, an open market now. The demand and supply is determining the price. Now let's understand what's on the global perspective. Because if we also know about Trump and Trumponomics, that's what we are hearing in all the headlines which I've been viewing in the media. Let's understand what's exactly happening on their front. So in the inaugural on 20th January, Trump obviously became officially the US president. He had been an earlier president in 2016 as well. From the 20th of Jan, he had announced the first set of tariffs on Mexico, Canada and China. And then with time, he announced second tariffs in February. He reversed those tariffs again, and again in mid of February, March, somewhere he again announced the third set of tariffs. But what was happening? All the announcements which were made, particularly when we talk about reciprocal tariffs, which was the third set of tariffs, they were also reversed and they were obviously given an extension to April 2nd. So as of now, we understand two dynamics from his perspective. One is to talk the talk, which means he definitely is doing something which he knows very clearly. It's not something which is unintentional or he is not aware of what he's doing. I don't think that's the case. We purely believe that there definitely remains a plan. One, to get all the countries back on the negotiation table in terms of revising the tariffs. And second remains the protectionist philosophy, by which I mean they want to protect the American manufacturing hub. They want to promote their goods to be sold within America first. Now what happens if this tariffs rises? So we believe, one, obviously it grows the tax revenue for the US. In case if any country does not want or look forward to pay any tariffs, then it's quite evident that these companies will have to settle down into the US, which means in turn they will have more FDI flows coming into US. If more FDI flows are coming into US, then it creates more job opportunities. When there is more job opportunities, there is economic boost. So there definitely remains a plan. That's what we are suggesting. On the contrary, there have been the second side of people which says that this may continue to remain uncertain and perpetual, which is creating a base case scenario of being volatile in terms of all asset classes, which obviously may remain the case. But we believe there is a synchronized way of their thought process. Secondly, what impact may India have because of this? It's quite important to understand that side, because India's exports to US are almost to the tune of $80 billion. Roughly, India's total exports to US are around 18%, which is roughly 2% of the GDP. Our imports from the US are to the tune of only 2%. So overall, the impact which we may have on exports can be a bit higher, because the average tariffs which we are levying on the US is roughly around 9.5%, and the average tariffs what US is levying on us is around 3%. So definitely our tariffs are way higher than what the US is charging us, and thus we anticipate that there can be some reciprocal tax arrangement or maybe some taxes which can be defined either product specific or sector specific, which time will tell us. But yes, we cannot ignore this fact because our dependency also remains on the export front to the tune of 18% of our total exports. Now, what happens to the Fed trajectory? The recent FOMC meeting did not cut rates as expected, so the rates still remain at 4.25% to 4.5%. We also believe this may continue even for the May policy. The FOMC dot plots were very clear that they still see uncertainties. Powell's speech also clearly states that they are not even sure that what kind of impact these tariffs will actually have on the market and on inflation front, which is so uncertain even now, which was a clear indication by Powell. But as per the Fed Watch tool, we still anticipate at least 2 rate cuts for this year 2025, and in 2026 one more rate cut in the first half. So basically 3 rate cuts by FY26 is what we anticipate. So if we talk about a terminal rate, the terminal rate should be somewhere around 3.5% to 3.75% when we talk about a Fed funds rate, which can be seen by FY26, that is March 2026. Now, what happens on the Brent crude prices, dollar index and dollar CNH pair, because they are all interlinked in some form or the other because of the tariffs. So if we first talk about the 10-year US Treasury yields and the interest rate trajectory which were decided, then we believe for this quarter 4% may act as a good base, while 4.65% can act as a resistance in terms of the 10-year US Treasury yields. While if we talk about the dollar index, we have seen sharp move from 109.80 to almost around 103 levels, and then currently trading at around 104 plus levels. The anticipation remains that 100.68 acts as a very, very important base and a strong support, which we feel that may not break in the quarter. While if we talk about the resistance, the immediate resistance from here remains 107.20, followed by the near highs of 109.80. If we talk about the oil prices did see a bottom around $69 per barrel, that is particularly the Brent crude prices I'm talking about. And we have seen that couple of times we have tested these levels and it has bounced from $69 per barrel. But there has been also sanctions which have been imposed on the Iranian oil exports, which is pushed by the US, giving some pressure on the oil prices to bounce back. Plus the OPEC Plus members have also decided to cut on their daily production until June 2026. So when we consider these two factors and the charts, the base case scenario remains 65 remains a very strong support on Brent crude prices, while the resistance acts as around $82 per barrel. Now let's move on to the dollar CNH pair, which is the Chinese yuan, because tariffs have direct linkage to the Chinese economy as well. But we have been observing that Chinese economy have been playing really very smart. Initially, the underlying assumption was always that in case if there will be tariffs, they may look forward to devalue their currency in order to promote their exports. But now they have been managing their currency very well. The PBO has been doing a really good job, and the dollar CNH pair remains in the range of 720, 730. 7.35, 7.37 acts as a very important resistance. It has tested a couple of times nearly, and even it's a decadal highs. While on the left, 7.12 acts as a very important support. Now let's move on to the Eurozone. We saw a rate cut in the ECB. So there has been a couple of divergences, and particularly when we talk about the Eurozone, the rate at which now they are trading is around 2.65%. Going ahead, they still prevail inflationary pressure to happen, and it will also depend on how the other economies play the second half of the year from here on. What anticipation we have in terms of the currency pair? Euro has recently seen a spike almost towards 1.09 plus levels. So we anticipate that 1.0420 acts as a good support, while on the right side 1.1150 to 1.1180 levels act as an important resistance. Let's go to the Bank of England, where Bank of England did not cut rates in anticipation of the inflationary pressure. But overall, in the trajectory by FY26, we anticipate 3 rate cuts from their side by around 75 basis point, maximum 200 basis point by FY26. So that's what our trajectory remains for the GBP dollar rates. But on the currency part, we anticipate 1.2420 acts as a very important support. While it has been testing this 1.30 levels couple of times, but in case if we see a conviction break of 1.3060 levels, then there is a chance of testing 1.3325 as well. Now let's move on to the Japanese economy. So Japanese economy has always been talking about a rate hike rather than a rate cut as compared to the other economies. But that has not been the case, at least in the first quarter. And we also believe, I think they are walking only by the talk and not in the actual actions, because that action itself is not necessary when the words are working for themselves by only saying and controlling the currency well. So for dollar JPY, we anticipate the range to be 142.5, acting as a basic support and a base. While if we talk about the resistance, then 157.5 acts as a very important resistance for dollar JPY. Now let's understand the dollar rupee pair, because that's what we are here for. All of us are quite thrilled seeing the volatility from 87.95. After the intervention, it went as low as 86.40, then bounced back again towards 87 plus levels, and now back to sub 86 levels again, testing 85.5 as well. So there has been a tremendous volatility when we talk about dollar rupee pair, which we never observed in last couple of years due to the different regime of intervention strategy as we discussed earlier. So 84.5, 84.80 acts as a very important support point, while on the right side 87.95 itself, which is the all-time highs, acts as an important resistance pair for the quarter. Obviously, a lot may depend on how the tariff structure may take place, but broadly this remains a range for dollar rupee. What do we advise for an importer as well as an exporter? For an importer, we believe that these itself are an important levels to hedge your exposure, because we have seen almost a 2% appreciation of dollar rupee pair, irrespective of the uncertainties which still prevails with Russia, Ukraine, with tariffs, with Iran, Israel, with Middle East, but we still have got such appreciation, so which has to be taken in stride by an importer. Plus, if you talk about the forward premiums, the 1 year annualized forward premiums are roughly at around 2.2%. So for an importer, our suggestion would be that anywhere around 85.5 levels, we should at least hedge 40 to 50% of our exposure. While in case if we are able to see a drop below 85.20 or to 84.5, 84.80 band, which is what we are anticipating as a broader band on the lower side, then further more additions of at least 40% to be done. So almost 80% of hedge can be done at 85.5 to 84.5 levels, in between those levels. While for exporters, I think there will be an opportunity, as we believe RBI may look forward to build FX reserves from here on back to the 704 levels. Considering the external debt of India is roughly around $712 billion. So we have seen in the past that they have tried to at least 95% to 100%, they try to cover the external dollar debt. So we believe there can be a possibility of rise in the FX reserves and some kind of a base bottom created by the central bank itself. So in that scenario, exporters may get a chance above 86 levels once again. So the first set of hedging may be done at around 86.20 to 86.80 levels, while we should have an ideal stop of 84.80 to 85 for ourselves as a stop. While on the right side, the second set of hedging should be done to the tune of 40% above 87.20 levels. Well, that's all from our side, friends. In case of any queries, suggestions or feedbacks, you can write on etcindia@shinhan.com. And once again, I am your host Kunal Sodhani from Shinhan Bank, and we are very thankful and hope you found our analysis useful. Thank you so much.